I started investing at 18 and wasted so many years because I didn't know this. So make sure that you go through this entire video because I'm going to be showing you exactly what mistakes I made and how you can make sure that you skip them. So the first thing that I wish I knew when I was 18 was to figure out my goals before I started investing. So there's so many different things that you can do with investing, right? You could take a really passive, hands-off approach and just buy ETFs every month, dollar cost average in there. You could do that. You could chase after dividends and try and live off the income from that. An alternative is to try and find high growth companies and act almost like an angel investor. So this is just a few of them, but there are so many different styles of investing and so many different ways that you can meet your goals. So out of everyone that I've spoken to, very few people actually have goals. And I remember looking back, I thought I was just some Warren Buffett type value investor. I read Intelligent Investor and then started buying random stocks. So I did this for years and I just buy random things just because I liked the idea of them. I didn't really research, I didn't do fundamentals, I didn't know any of that. And I just bought stuff because I liked the name of it. So I did this for years and my results were pretty bad. You know, I had some good ones, most of them were bad, but nothing great. And then eventually I started getting more and more into it and I found out about ETFs. And eventually I started to buy ETFs. And then I started to do dollar cost averaging. And again, my results were still average. It was always this 40-year, 50-year time perspective that I wasn't willing to do, right? And it took me decades for me to figure out that you can actually turn your stocks into a weekly income. So I learned cash flow investing after about, I'm embarrassed to say, like 10, 12 years of investing. And it just completely changed for me then. So I always knew that my goal was, generate cash flow. I always wanted to retire young, be financially free. Those are always my goals. And cash flow investing is exactly what got me there. So I wish that I had known this, or at least put a concerted amount of effort into figuring this out before I started investing, because I could have saved decades of my time, right? So if you want to get a one-page PDF that shows exactly how I turn stocks into weekly income that I live off every single week, then I want you to comment stocks below and I'll send it to you, or you can just click the link in the bio and download it. The second thing I wish I knew was the idea of divorcing myself from my stock portfolio. So this doesn't mean just buy random things and don't care. What it means is do your fundamentals, make sure you love your stocks, do all of that so that you're really happy because you're buying a portion of that company. But then once you've bought it, try and take the emotion out, divorce yourself from that stock. So the thing with markets, and this is just my current working understanding of it, is they work on expectations as opposed to fundamentals. So you'd think that a company has amazing results and it goes up, but that's not how it works. Generally, a company can have incredible results in their earnings and it'll still drop. And the reason why is because it's based on expectations. They're analysts and they're hedge fund managers and investors that have an expectation for that stock. And if it doesn't meet the expectation, it drops. So it's all almost like a popularity contest. It's based on expectations and what analysts and these people view of the stock. So what this means is you can spend your life researching stocks, the best fundamentals, the stars can align and you find the perfect company, but it still drops 50% or more just because it didn't meet an analyst's expectation. So this has happened to me so many times. In the past, I used to panic, and when it dropped, I'd sell and I'd lose money. And then when it went up, I would buy hypey stocks because I didn't want to miss out. So this is what I mean. Just strip yourself away. Strip out the emotion away from your stock portfolio. So if the price is dropping and the company's great, the fundamentals are great, you love it, you buy more. It's a sale, right? It's a discount on the stock that you love. You're taking a long-term view on this company. If the company's at its peak, don't buy it. Like, why would you buy it in its most expensive form? There are thousands of companies, go and find something else. All I'm trying to say is pull your emotions out of your decisions and you're going to find you make significantly better decisions. So the third thing that I wish I did was follow the news, but don't take it seriously. And I know this sounds something like really weird to say, but what I wish I did was every single day, sit there and type into Google, US stock market today, and just go and read through there and get an understanding. I do it now, and it's been incredibly valuable for me. So what it tells you is it does a few things, right? It gives you a very clear understanding of what's happening in the stock market, what Trump's doing, what's happening with all the different countries and all the different parties involved in the stock market movements. But what it also does, it gives you a meta understanding of what the market's afraid of. So what I mean by this is, if you look at today, so everyone, all the investors are worried about the tariffs, Trump and the trade tariffs. And the other thing is the idea of an AI bubble. So you know that investors are afraid of an AI bubble. So it makes sense that any company that's directly related to AI or even indirectly related is going to be under a high amount of scrutinization, right? People are afraid that there's a bubble. So there's going to be a lot more volatility around that space. So this helps you make better decisions, right? Because if you know that NVIDIA is having an earnings announcement, you know that it's going to be extremely volatile. And it completely changes the way that you look at this because you know it's going to be erratic. So also indirectly, it's important to know what companies are indirectly related to, say, something like NVIDIA. So if there's negative news on AI, NVIDIA tends to drop, but what else tends to happen? You know, things like Astera Labs drops, or databasing things, semiconductors, chips, those all tend to drop. And things like T-Mobile, which is a cell phone company, tends to rise because it's more stable and safe. So once you understand these and how the different companies interact with each other, you can get a very good idea of what you think is going to happen. So that's why I strongly recommend you do it. Just follow the companies that you do, and every single day go into the stock market and take a look at it. And now the caveat that I mentioned is take it with a pinch of salt. So it's really, really well documented that negative news headlines tend to get more clicks. So it's really important to understand that a news company like Yahoo Finance, CNBC, whatever they are for-profit companies. So they're making money on your attention. They're trying to show you ads. They're making money on your clicks. So obviously they're creating articles and content that are more likely that you're going to click on them. So it makes sense that they'd make negative headlines, right? Are you going to click on, you know, great news for investors today, which is more curiosity, or, you know, oncoming recession? So generally more people are going to click on the recession angle. So what I'm trying to say with this is that the news is inherently negative. It's just biased towards that. So in the past, I would spend a lot of time delaying investing, making decisions based on kind of fear because I was afraid of a crash or an oncoming recession. So if you go and read the news now, you'll see a lot of AI bubble news. So is the AI stock market about to crash? Things like that. That's a very hard-hitting subject line. So you know that that's going to get a lot of clicks, but it's not necessarily accurate. They could go to Twitter or X or whatever it's called now and go and find one person that says there's an AI bubble, and suddenly they've got an article and they can use that as proof. So what I mean is take it with a pinch of salt. I'm going to create a video in the future that shows you exactly how to interpret the market and its health and the chances of a recession, but you'd be significantly better off if you just went to ChatGPT and you said, what are the chances of a recession in 2027 or 2028 or whatever you wanted to know? You'd get better answers doing that than you would looking at news headlines. I know so many people that don't ever enter the stock market, they don't take it seriously, they don't invest time in it because they're constantly reading these news articles and they think that there's a crash coming and there's constantly a recession. And this is something that I really don't want for you. I found it really helpful to just understand that the news doesn't necessarily have my best interests at heart. They want my click. So these are the three things that if I could go back, really, really would have helped me. They would have reduced the emotional roller coaster of investing. They would have given me better fundamentals and helped me make better decisions. If you enjoyed this video and you want to learn more about how to turn stocks into cash each week or cash flow, then please like and subscribe, continue watching. It really helps me, and I want to get this information in as many people's hands as possible. So thank you for watching, and I'll see you in the next one.